Good morning, YouTube. It is Ockynomics, and welcome to the first episode in our stock analysis series. Today's stock that we're looking at is Apple, or the ticker symbol AAPL. One thing about Apple is a lot of people consider it the shiny rock on the hill, and people believe that Apple is a good stock, which I mean it is, right? People see Apple, people know Apple. Our iPhones are made by Apple. Everyone knows Apple, and since everyone knows Apple, everyone assumes it's a good stock. And because of that, whenever you see Apple down in this type of market, it might set off some alarms, you know what I'm saying? So what we're going to sit here and do and try to figure out today is Apple worthy of being called an amazing company? So currently, right now, the stock price is $138.20, right? And if we click here, so we see right here, $138.20. That's the current stock price right here. You can see right here my arrow, my mouse. It's down $4.28, which is 3%. And if we look right here towards my arrow, the 52-week high is $182.94. So yeah, this stock got beat down, right? And the 52-week high, if you guys don't know, basically is the highest price the stock hit in 52 weeks, right? So from 138 to 182, that's a 25% down. And y'all could do the math, because I did the math beforehand, and it dropped to 25%. So a lot of people might view this and think, well, we have to sell. We have to get out of here. Wrong. All right. I'm not a financial advisor, so you shouldn't listen to me. This is what I'm saying is not financial advice. I'm not a financial advisor. But a lot of people would view this and think, maybe we should sell the market. You can't make no money off the stocks. And that's a fool's way of thinking. So one thing I like to do to analyze a stock is what people like to call fundamental analysis, which is simply looking at the fundamentals of a stock. So let's go look at the first thing, which is PE ratio. The PE ratio, in layman's terms, is the price to earnings, right? You take the price of the stock, $138.20, and you divide it, right, by earnings per share. So right here we have the PE of 2264. This is Weeble's PE. I did some research on my own, obviously. Right here, I found this Simply Wallet. There's a few things condensed information, and I'm just looking for it. It says right here, Apple's good value price to earnings ratio of 22.3. What people normally look for is they want a PE of 25 and below. And you might be wondering, what's the importance of PE? PE lets us know if a price is fair, if the stock is fair valued, if we're paying more than we should or if we're paying less than we should. So right now, this PE lets us know that this is a good price, right? It's not really overvalued, it's not really undervalued. So I'll give that a check. The next thing we want to look at is ROI, return on invested capital. This is very important because I'm just looking for it. That's something else. Nope, that's something else. No. So the next thing I like to look on in the fundamental analysis is ROI, return on invested capital. I'm going to say it one more time. Return on invested capital. This is very important because it lets us know what the company is investing in, right? And how much growth what is the return on the money they're investing, right? They put in, let's say, more money into acquisitions or trying to acquire more companies. Well, once they acquire the company, what's their return on that? How much do they make? How much do they grow off that? And this is important. You don't want to have a company that isn't growing that much. You can't have it, but if you're trying to make money, for example, a company that has little to no room for improvement, I mean, the value of the stock isn't really going to go up. However, in this case, as we see right here, this is the 5-year return on invested capital of Apple. So we look at 2017, 17.61, 23.92, 23.71, 26.28, and an astounding 41.98%. So what I like to do is, we add them up, we add up the percentage, we divide them, and we get a ROI of 26%. This is crazy, guys. And I'll tell you why this is crazy. We want an ROI of 9% or greater, and Apple killed it. 26% on the ROI. Very amazing. This company has a lot of room to grow, and there's still a lot of industries that this company can enter in that it hasn't entered in already. For example, the car industry. There's still a lot of stuff in that industry that could literally make their own cars. Come on. Now the next thing in our fundamental analysis is the shares outstanding. So we'll go right here. Shares outstanding. So what is the shares outstanding? We want the shares outstanding to be the same or decreasing. If a company is decreasing their shares outstanding, they're buying back more shares. What does that mean for us? If they're buying back more shares, there's less shares in the market for people to buy, meaning that the value of our share, I don't charge my laptop. The value of our share is increasing because we own more of the company. However, if the company is increasing their shares outstanding, they're selling more shares, they're selling more stocks, and they're diluting you as an owner, meaning the value of your stocks is going down. So we don't really want that. And as you see from the chart right here, quarterly shares outstanding, it was rising a little bit, right? But this was years ago. We're looking at all right now. And I don't really have date. Yeah, from 2014, 2013, or 2013 around here, they started decreasing their shares outstanding. Look at that. Boom, boom, boom. They're driving that price up. They're buying back shares. And that's what we like to see. However, let us go back to Webull. 138. We saw that from the chart that they were buying back shares for about 4 or 5 years. So they're buying back really expensive shares from right here, where Apple hit its lowest, 52-week lowest, and then right here back when it's pretty high. We love it when a company buys back more shares, but what we don't love is a company that buys expensive shares. And you might be wondering why. I mean, why would we want them to buy expensive shares? Do you want to buy expensive share Apple? No, it doesn't really make any sense, right? There's a lot more better things they could do with that money than just buy back expensive shares. Alright, beautiful stuff. Next thing we want to check is the liabilities. Liabilities is basically, if we can go back here, Financial Hope, I believe, was in here. Alright, the next thing, this is going to be the last thing I talk about in this fundamental analysis, is liabilities. You want to look at the long-term liabilities / debt. So I took the liberty of doing all the math for you guys. I can't really show you that it was really hard to find their balance sheet, but I do have the numbers, so I'm reading off to you guys. So their 5-year average cash flow, right? We're gonna multiply that 5, which is $375 billion. We want their liabilities to be at least lower than that number. Maybe like half would be good, but we want it lower, as long as it's lower. Their liabilities is $155.7 billion. They crushed it. And you might be wondering, oh, why is debt so bad? Isn't debt supposed to be good? Well, not really, right? Especially in this type of market, we have the Fed increasing interest rates. We want a company that in the dark times, when times get tough like now, their debt, they could easily pay it off and they have nothing to worry about. And clearly Apple, in these tough times, are able to pay that off. So, after all that, you must be wondering, well, Ockynomics, what do we think of Apple? I think Apple is a beautiful addition to your stock portfolio if you're a long-term dividend investor, right? Their dividend is not as high as compared to other companies. If we look at their dividend, it's only a 0.66. But a low dividend means that when they pay it off, it's not taking too much money from their cash flow. And if it's not taking too much money out their cash flow, we know that they can easily pay it. And we know that this dividend isn't going anywhere, right? Because if they can easily pay it, why would they get rid of it? It makes the investors happy. It makes the company look better. So there's no point in getting rid of it. Easy way to pay it off. And we saw that they had $375 billion in their 5 years as free cash flow. I mean, like, come on. However, I say Apple, personally for me, is too expensive right now. I think Apple has ways to go and getting beaten down, especially since it's hitting its 52-week low. I think it'd be very interesting if when it hits it, I believe it will hit it. And this stock should definitely be on your watch list. Once again, I'm not a financial advisor, but if I were to pick a perfect price to start maybe looking at buying it, I would say around probably like 110. And you must be saying, but if the 52-week low is 128, you really think it's going to hit 110? Yes, I do. It dropped 25% from a 182-week high, right? Especially with how red and bearish people are in the market. Bearish meaning that people think the market's going to keep going down. This stock definitely has a way to go down. Definitely should be in your watch list. Alright, thanks for watching, guys. I hope you enjoyed. Like, subscribe, share, hit the post, hit the noties, join Noti Gang, and I hope you guys have a good day.